I'm Charlotte McLeod with the Investing News Network, and here today with me is Jeffrey Christian, Managing Partner at CPM Group. Thank you so much for being here online with me today. Great to see you.
It's always a pleasure to be with you. Yes.
Yeah, so we've got a lot to talk about today, but I was hoping we could start off with what's going on with the current Russia-Ukraine tensions. I've seen a lot of back and forth in the headlines about this, and of course, it's creating a lot of uncertainty for investors. I wondered if you could begin by going over the reaction that we've seen from gold so far.
Well, it's really interesting. I mean, gold is has been very volatile. So, yesterday there was this talk about the Russians maybe pulling back a few tanks, and the price plunged down to 1845, 1846. Today, people are saying, well, that's really not the case, and the risks are still there. So it got back up to 1866. And I think that gold and other financial markets should expect to continue to be volatile. I'm not sure how this gets resolved. No one knows how it gets resolved. The risks of an invasion are there. Even if they don't invade, there will continue to be tremendous tensions between Western Europe, the United States on one hand, and Russia. There are a number of issues going on within Russia that have sort of factored into this, and there are a lot of issues in the United States, in the military, in the government, and in NATO that have also contributed to where we are today. So I don't think it gets resolved easily or soon, and I think it is going to continue to be a source of volatility as investors get whipped back and forth by the latest news.
Right. And you shared with me a note that you had written for CPM Group. And I thought that that really highlights the uncertainty that's out there, as well as the range of gold price reactions that we could get. So I wondered if you could go into some of those scenarios that you laid out and talk about that a little bit more.
I'm not quite sure what all I sent to you, but I guess we were talking about one of our trade recommendations in which we said, look, on the one hand, if Russia invades Ukraine, it will be bogged down. It would be bogged down in the Ukraine as long as it's there, and that could be a long period of time. And you have to take into account, Putin is of the view that most people are of the view that the Soviet invasion of Afghanistan in 1979 was the ultimate precursor of the demise of the Soviet Union, and Putin has the view that they should have just bombed the heck out of Afghanistan. And his rise to power was Yeltsin asking him to deal with the Islamic rebels in Chechnya and other Caucasus republics, and he bombed the heck out of them. He killed hundreds of thousands of civilians as well as rebel fighters in subduing that revolution. And so, first takeaway is, he doesn't mind killing hundreds of thousands of civilians in order to achieve his political goals. Second thing is he has, as I said, domestic political issues there. But if he goes in, they'll be bogged down for a long period of time. It'll be very beneficial for NATO, for the US government, and for the military arms complex, in the United States, the United Kingdom, and France and Germany. And as long as he's there, he'll have problems. If he doesn't go in, then there are two different scenarios. One is he backs off. He loses domestic support, further support. He's already suffering from a diminution of domestic popular support, increased dissatisfaction with his government. If he stays on the border and continues to make his point, that's probably the best outcome right now. Hard to say. If you look at it from a Russian perspective, he's sitting there. NATO is all around him now. We have a U.S. air base in Kyrgyzstan. We have U.S. military coming through Uzbekistan. You had riots, anti-government riots and a potential revolution in Kazakhstan, which Russia sent in troops to quell. You've had revolutionary protests and demonstrations in Belarus for about 2 years now. So he's looking at a sharply diminished empire. He wanted to rebuild the empire when he took over in 2020, and it hasn't happened. So he's got some real issues there to resolve. And I think that this is going to stay problematic for him and for Russia and for the world, and continue to feed into financial market volatility for some time to come.
Okay, and we've got all these things going on, a lot of uncertainty as we've been discussing. What's your advice for gold investors in a situation like this? How should they be reacting in these times where you don't really know what's going to be happening next?
I took some opprobrium within CPM Group last week. We issue these short-term gold and silver buy recommendations. And late last week, we said, look, we think that the gold price could spike down to 1845, and it could spike up to 1865. And right now, you may want to just stand aside if you're a short-term investor. If you're a long-term investor, you look at this, you look at what the state of the world in general, and you say, I want to own gold, and I want to own more gold. I want to have more of my wealth in gold. So it's not that the price is going to run away to the upside, but you just want to have a diversified denominator of your wealth, as well as you want to have exposure to gold, because there probably will be capital appreciation. There are bigger issues in interest rates and inflation and overall economic conditions. There's domestic political unrest in the United States. There's rising nationalism in Europe. There are political issues in China and India and other parts of the world. There are a host of other issues, all of which sort of say, you probably want to own more gold rather than less gold right now. So I think it's basically, from a longer term perspective, you might want to stay, you're going to stay long with the expectation that the gold price is going to rise. From a short-term basis, you have to pay attention to that volatility. So last Friday, we said, well, just stand aside. Well, the price spiked down to 1845, 1846 yesterday. It spiked up to 1866 today. And, there are people within CPM Group who said, well, we could have advised our clients to make $19 on the downside and $20 on the upside. I said, yes, but there are very few people who are facile enough to do that.
Yeah, that's right. Of course, it's very individual and people have to consider their own goals. So we're going to move on to talking about some of the other gold price influencers that you're mentioning. But before we leave Russia and Ukraine behind, I want to touch briefly on metals beyond gold, because Russia is a producer of platinum, as well as especially palladium. And I wonder if you want to mention any impact we might see on those metals as we continue down this path.
Well, you have seen increased volatility, especially on palladium, because Russia is more important to palladium than platinum. But the Russian government and the Soviet government before it were always of the mind of I can't remember the political term right now, but they disengaged commerce from politics. So they never really used exports of oil or gas or platinum or palladium or gold as a political tool. And they say, okay, fine, we may be at war, but I'll gladly sell you platinum. So I think that the supply of platinum and palladium will continue. It may have to get rerouted through other countries if there are sanctions. But I think just as there were sanctions in the past, and you saw metal going through the Netherlands or Ireland to get to the fabricators in Italy and Germany and France and the UK and the United States, I think that you'll see the metal flow. But there'll be concerns about the supplies, which could hit the market price higher at times.
Okay, very interesting. So moving on to some of these other factors that are impacting gold right now, we have this geopolitical situation that's going on, but in the background, of course, I think one of the main issues that people are wondering about is the next steps from the Federal Reserve. And actually, I think later today, we're going to get their latest meeting minutes. So I wondered if I could get your thoughts on what you see coming in the next months from the Fed.
Sure. I think you'll see higher interest rates, and you'll see a continued withdrawal from the quantitative accommodations that we've seen over the last period of time. Exactly what they've been saying. The important point in my mind is A, the level of interest rates, B, the speed of increases, and C, why they're increasing, and D, how the markets interpret that. So the fact of the matter is you've got, short-term rates virtually zero for an extended period of time, real interest rates negative, going even more negative because of rising inflation. You're starting to see interest rates rise. The 10-year bond has gone from less than 1% a year ago to about 2%, a little over 2% right now. You're probably going to see further increases in interest rates, but they're going to be so low that they really are unlikely to have a major negative impact on the overall economy. They may quell some inflation, which may quell for other reasons too. So we don't think that rising interest rates are going to have a negative effect on gold. But the real important thing, okay, the level, very low. The Fed has said, and we've been saying it for some time, and the Fed has said last year, they think that real interest rates stay negative for the next decade. And they've been negative for most of the last 12 years already for short-term treasury rates. So yeah, it's more of the same. Even if they rise sharply, they're still going to be very low. They probably will not be a threat per se to gold prices. Where they might have an effect is that, investors have to choose sides, inflation and the Fed. Which one do you think is going to win? Now, the gold bugs have been saying for 40 years that the Fed has lost control. And they're saying it again. The Fed doesn't have control. They don't have any bullets. They have trillions of dollars of bullets. They have more ammunition than they've ever had before, and they know how to use it. Investors have the gold bugs are saying, oh, the Fed's lost control and inflation's out of hand. But mainstream and most other financial analysts, economists, market participants are saying, no, I think the Fed can actually control this. And I think that as you get into the second quarter in particular and the third quarter going forward, what you're going to see is the consensus in financial markets is going to be the Fed will probably be able to control inflation, aided by other factors that have nothing to do with the Fed policy, but simple arithmetic and also broader real economic trends. So we think that what you'll see is that investors will say, okay, insofar as gold is an inflation hedge, inflation's not a factor causing me to buy gold. But that's okay, because gold has gone from $270 in the year 2000 to $2,000, and it's still $1,865 in a period of time when inflation was never over 2 or 3%, and it was actually declining. Investors have been buying gold for a host of other reasons, not inflation. And the fact that inflation may not be at the table probably is far less important than a lot of people think.
Okay, yeah, this is very interesting because this is basically not what I hear from most people. There is definitely that narrative of the Fed has nothing left. They can't get out of this. So let's talk a little bit more about that, because are you saying the Fed can get inflation under control and people will still have reasons to buy gold without inflation? Maybe you can talk a little bit about that and some more about the price impact, if you could.
Sure. So you've seen this tremendous increase in gold prices over the last 20 years. And during those 20 years and the preceding 20 years, inflation was not an issue. What was an issue was overall economic conditions, interest rates, the stock market, political issues domestically, international political issues, gold as a form of savings. We gave a speech in November of 2000 where we recommended buying gold. And we said gold is going to enter a golden renaissance where people start using gold more. And in the ensuing 21 years, private investors have bought 600 million ounces of gold. Private investors own 1.4 billion ounces of gold, 600 million of which was bought in the last 20 years. If you go back to 1966, when private gold ownership was really opening up in Europe, Anglo-American did a big study, and they estimated that there was about 344 million ounces of gold held by private investors worldwide. So we've bought almost twice as much in the last 20 years as had been accumulated throughout time up to 1966. So investors were buying a lot of gold, not because of inflation, but because of all of those other things. I want to have gold as a portfolio diversifier. I'm worried about currency market transitions and volatility. I'm worried about the stock market being too high or the stock market's falling. I'm worried about interest rates being so low that it doesn't offer me a return. There's been any number of studies that CPM Group has done that show that you should have more gold in your portfolio rather than less. So there have been a lot of factors that have caused investors to buy gold, and that's probably going to continue to be the case.
Okay, that's helpful. So if we go forward into this scenario where the Fed does get inflation under control, can you talk a little bit about what we could see in the US economy and the stock market during that time?
Well, my colleague Rohit Savant and I were in a meeting last year with an investor, and somebody said, we were talking about the state of the economy, and the investor said something about the stock market, and Rohit just laughed. He said, no, we're talking about the economy, not the stock market. Completely separate entities. And my old boss at Goldman Sachs, Leon Cooperman, used to say that the stock market had predicted 14 of the last 6 recessions. It's another animal. But first, looking at the economy, inflation comes under control. We're moving forward. We're still worried about deflation on a long-term basis. The lockdown and the pandemic have caused changes in the labor market, which we have to see how it's going to shake out. But the reality is, despite current labor shortages, in the US, in Europe, on a global basis, we have a surfeit of labor. There's way too many people, and we're moving to computer manufacturing, computerized services provision, automatic checkouts, automatic fast food restaurants, even robots in sit-down restaurants now, computerized agricultural things. I mean, you have computers working in the fields of California. So we think that from a long-term perspective, you're still facing a lot of deflationary pressures with surplus labor, surplus commercial real estate, surplus retail capacity, surplus manufacturing capacity. So we think there are a lot of deflationary pressures which will limit growth and also cause increased uncertainty, which we think will be reflected in stronger demand for gold. Gold does well in periods of time, periods of depression, as well as periods of time of strong growth and inflation. So I think from an economic perspective, we see continued economic growth, subpar. We just issued we just revised our 10-year economic projections, and we revised them down maybe 1/4 percentage point over the next 10 years in terms of global growth. So we think that growth will continue on a global basis, but it will be hampered by problems with international trade, problems with international relations, the bifurcation between China and the rest of the world. Russia is going to continue to be a problem and an issue that has to be dealt with. So we think that growth continues. The stock market's a different animal because the stock market has been fueled by this enormous amount of money that's come into the economy. And everybody talks about the Fed and monetary accommodation, but they don't talk about the fiscal stimuli. And when you start talking about, well, the Fed can pull back its monetary accommodation, it can raise interest rates, it can buy fewer bonds and suck money out of the circulation. That's monetary policy. We haven't even talked about fiscal policy, which remains extremely stimulative, not only in the United States, but around the world. And that has inflationary implications, and it has a lot of other problems too. So there's still a lot of other issues. But when you look at the stock market, it has been fueled by this enormous amount of money that's come in and by tax policies, which have given people even more money to go back. So the stock market has been on an extended sugar high, and it is possible that what you will see is a reduction in the stock market and the reduction in the attractiveness of the stock market. And it's pretty interesting because if you look at the stock market rising, and it has been rising overall, we've gone through some stormy weather over the last 2 months, but we're still at or close to record highs. And we're much higher than we were a year ago or any other time in history. But if you look at the stock market, you're seeing trading patterns very similar to what you saw in 2000 at the time that we said, hey, buy gold because the world's changing. And what you're seeing is a handful of tech companies gruesomely overvalued, driving the stock indices higher, with the vast majority of stocks underperforming. And that means you've got a empty shell or a quasi-empty shell or a Potemkin village, if you want to, stay with the Russian theme. You have a real issue there. And that could cause investors to pull away. But there's a bigger, longer term issue, which is that within the stock market, you've seen an increase in retail investors giving their money to money managers to manage. Ever larger entities saying, okay, we have too much money to spend our time looking for individual stocks. So we're going to put money into indexed funds and ETFs. And lo and behold, over most of the last 5 years, the ETFs and index funds have outperformed the humanly managed funds. So, hey, we're facing cost pressures and pricing pressures. So let's get rid of the traders and just replace them with computers that are going to do buy and sell recommendations based on share price momentum. So you have a lot of issues that the stock market and equity markets are facing, and they have negative implications for capital formation. You also have the stock market up because of decapitalization. Companies taking their profits and buying their stocks back, reducing the number of shares out there, boosting the price higher, makes their shareholders happy, but it doesn't do anything in terms of capital formation and the provision of capital for plants, equipment, and hiring people.
Okay, now I don't want to take you on too much of a tangent, but you mentioned, the fiscal side is something that gets ignored. We're all focused on the Fed. Are there any key points that you would want investors to know about in that area?
Well, I wrote a piece in I think 2012, which people still ask me for, ways that we could reduce the fiscal deficits, possibly even restore fiscal surpluses and start paying down sovereign debt. Not only in the United States, but in other countries. The other countries have worse situation, and that has important implications for the dollar and consequently for gold. But, you could actually solve your fiscal problem. The problem is that there's no political will to do that right now. We had political willpower after World War II in the 1950s and 1960s. You had politicians that say, look, we just can't keep spending it based on debt. We have to pay down the debt. The debt to GDP ratio was actually higher in 1947 than it is now. But we reduced debt as a percentage of GDP by growing the economy and by having a 91% marginal tax rate. You don't have to have a 91% marginal tax rate to reduce the debt now, but even if you raise the marginal tax rate 5%, you would all of a sudden probably slice a quarter off of your deficit. So fiscal policy can be reformed positively, but there's no political will. There's no politician in the United States or elsewhere that's going to stand up and say, let's do this. And there are no voters that'll say, hey, this is going to hurt me, but it's for the better kind of our country. So I'm willing to pay these kinds of taxes and I'm willing to put up with this. You also have things like the fact that since World War II, every congressional district has at least one military base and one military contractor, which means that anytime you want to cut your budget, your military budget, which is bloated in the United States, you're going to have every politician in Congress saying, wait a second, that hurts my congressional district.
Okay, well, you've given us a lot to think about today. I think we can wrap it up there unless you have any final words that you would want to add for the audience.
I think that's pretty much it. I mean, what we've done is we've gone through a litany of issues facing the world. And when the litany of issues are facing the world, they're facing individual investors. And when you have these kinds of issues and uncertainties, it's always good to have a portion of your wealth in gold and silver.
Okay, well, we'll leave it there. Thank you so much for coming on to talk to us about what's going on in the markets today.
My pleasure.
Okay, and once again, I'm Charlotte McLeod with the Investing News Network, and this is Jeffrey Christian with CPM Group.